Why do most mid-career professionals unknowingly compromise their long-term wealth optimization while chasing the comforting promise of absolute financial preservation? Imagine sitting across from a polished advisor who hands you a contract promising that your principal is 100% legally protected. They guarantee that every single dollar you pay in premiums will eventually flow back into your pocket as secure cash flow. You sign the document with immense confidence, believing you have just erected an impenetrable fortress around your family's future balance sheet. But what if that feeling of total security is the exact psychological mechanism being used to quietly dismantle your purchasing power? This absolute asset protection model triggers a severe structural drag on your capital, shifting billions away from your personal accounts. The entire framework is designed to divert potential compounding gains directly onto the institution's highly profitable long-term balance sheet instead. If you disconnect from this breakdown now, you will continue to mistake nominal financial stagnation for real, long-term financial stability. The fundamental flaw lies in the profound divergence between basic nominal preservation and real, comprehensive macroeconomic opportunity cost metrics. Over a 30-year horizon, any asset that merely breaks even in nominal terms loses over half its real purchasing power. Continuous monetary inflation silently devalues your locked capital, turning a guaranteed principal return into a guaranteed real-term wealth deficit. These bundled hybrid contracts operate as an encrypted asset ledger with an intentional, built-in mechanism that restricts asset velocity. The financial institution takes your high premium payments and immediately deducts substantial upfront commission structures and corporate administrative overhead. Your remaining capital is not safely preserved in a vacuum. It is immediately deployed into high-velocity corporate compound engines. The insurance institution systematically captures the robust 8% to 10% historic market returns using your aggregate contract capital. Meanwhile, your personal portfolio ledger is permanently restricted to a flat, minimal baseline that fails to outpace macroeconomic factors. Large institutions successfully weaponize your natural behavioral finance biases and innate loss aversion to accumulate massive corporate wealth reserves. If you want to continuously upgrade your financial intelligence and permanently deprogram the cognitive errors that drain your real worth, hit the subscribe button right now to join our global network of analytical wealth builders and master long-term optimization. Let us audit the exact financial velocity of two distinct consumer profiles operating over a standard 25-year career span. Consumer A channels exactly $1,200 every single month into a rigid bundled whole life insurance policy and annuity retirement framework. Consumer B cleanly unbundles their strategy by choosing to isolate their risk mitigation completely from their long-term wealth accumulation. They secure a pure, low-cost term life insurance policy alongside comprehensive long-term disability coverage for a fraction of the cost. They then automatically route the remaining $1,000 monthly balance directly into a low-fee, high-velocity equity index compounding machine. As the decades progress, the structural divergence between these two capital management methodologies creates a massive, irreversible gap in net worth. Let us visually map the precise long-term economic trajectories of these two sharply contrasting asset management frameworks. Consumer A remains entirely locked within the bundled framework, automatically routing $1,200 every single month for decades. A significant percentage of this massive monthly capital allocation is immediately consumed by severe contractual overhead. Their accumulated capital moves along a heavily restricted path, completely separated from real macroeconomic growth opportunities. After a grueling 25-year career span, Consumer A's total nominal principal return finally reaches exactly $360,000. However, due to continuous macroeconomic inflation, that nominal $360,000 has lost over half its actual purchasing power. Now let us audit the alternative path executed flawlessly by Consumer B using an unbundled model. Consumer B secures a pure, low-overhead term life insurance policy for an incredibly small fraction of Consumer A's cost. They simultaneously secure comprehensive long-term disability coverage to completely insulate their household from sudden catastrophic risk. Because their baseline protection is optimized, they automatically route the remaining $1,000 monthly balance into capital markets. This clean $1,000 balance flows directly into a low-fee S&P 500 equity indexing engine every single month. Free from artificial institutional performance caps, their capital captures the full velocity of historic market compounding engines. Over the identical 25-year timeline, Consumer B's independent wealth accumulation engine surges past $1.2 million. The resulting wealth gap represents a staggering difference generated entirely by choosing structural optimization over nominal preservation. Consumer A paid an immense compound interest penalty to maintain the purely emotional guaranteed protection paradox. To completely break free from this systemic asymmetry, you must actively implement the scientific Unbundled Protection Protocol. This advanced asset management strategy requires you to permanently segregate your risk mitigation entirely from wealth accumulation. Never rely on a single, complex financial product to solve two completely diametrically opposed economic problems simultaneously. Tomorrow morning, open your personal financial portfolio dashboard and execute 3 explicit, scientifically driven structural steps. First, isolate and calculate the exact annual premium load and administrative fee structure on any hybrid contracts you hold. Second, request a formal in-force illustration from your current provider to audit your real net rate of return. Compare this hidden internal return directly against core market indexing benchmarks to reveal the real nominal stagnation. Third, establish an independent, automated wealth accumulation bridge entirely utilizing low-overhead, highly transparent market index funds. Maintain your pure, unbundled risk protection policies separately to secure absolute coverage without paralyzing your capital velocity. Stop paying an uncalculated opportunity cost for an emotional illusion and start running your household like a sophisticated macroeconomic institution.